Welcome to our conversation on financial statement analysis. In this session, we will focus on one particular performance indicator, which is called free cash flow. But before we get into the details of free cash flow, let me tell you that free cash flow is not a GAAP number. That means you normally don't see this number on the annual report of the company. However, this is an important number for the analyst for the valuation of a firm. And the free cash flows for the FCF can be called free cash flows for the firm or free cash flows for the equity. So as we move along, we will understand the difference between free cash flows for the firm and free cash flows for the equity. But what is free here? The free cash flow for the firm is the cash flow available to all investors, the debt holders, preference shareholders, and common shareholders. So the word free here is not free of cost. It conveys it is free of any claims or free of claims of other stakeholders other than the debt holders, stockholders, and common stockholders. So this free is free of encumbrances, free of claims. So this is the money available, cash available for the investor. This can also be referred, many books and many online sites call this as an unlevered cash flows, unlevered free cash flow. It represents the surplus cash available to a business if it is a debt free. That means it's an unlevered cash flow. So free cash flows to a firm less the interest payment and the changes in the debt is called free cash flows for the equity. So in this exercise and in this presentation, we'll focus on free cash flows to the firm. And once you understand the free cash flows for the firm, from there, if you adjust the interest payment and the changes in the debt, you get free cash flows to equity holders. So free cash flows for the firm, as I mentioned, is not a GAAP number. However, you can derive it from either sales or from profit after tax or from PBIT, profit before interest and tax, or you can calculate from NOPAT, or even you can calculate it from the CFO. So free cash flows for the firm can be calculated from any number given in the annual report or given in the financial statement. Let us pick up one by one. So free cash flows from EBIT or PBIT. We know that PBIT is the profit before interest and tax. This is profit. And profit is derived or determined, calculated by using the accrual principles, right? And also the matching principle. So you need to make an adjustment. So FCFF is adjusted PBIT. Adjusted for what? Adjusted for depreciation and other amortizations. Adjusted for the changes in a working capital. Here I written less increase in working capital, add decrease in working capital. So therefore, changes in a working capital. Throughout this presentation, I'll be mentioning this increase in working capital. But we should also understand that it can be decrease in working capital also. In that case, it has to be add. So you can say plus minus changes in working capital and less CAPEX. CAPEX is a capital expenditure. Okay, capital expenditure. So FCFF can be derived from PBIT or EBIT as EBIT less tax, add depreciation and amortization and other non-cash items, plus minus the changes in the working capital other than the cash. Okay, CA minus CL other than the cash, and CAPEX, because we'll take an example to understand the calculation. Similarly, we can also calculate from PAT or net income. FCFF from PAT is equal to, you please make an adjustment for interest, because the PAT is after interest. So we add back interest, and once you add back interest, you also have to adjust for the tax benefits of interest. So therefore, this is adjusted interest, which is I into 1 minus T. Then add depreciation and amortization for non-cash items, add or changes in the working capital, less increase in working capital, add decrease in working capital, and less CAPEX will give you same amount of FCF, whether you are calculating from EBIT or whether you are calculating for PAT. The amount of free cash flows are the same. Similarly, we can also calculate FCFF from NOPAT. NOPAT is a net operating profit after tax, but before interest. And the NOPAT is normally or usually used for the calculation of EVA, economic value added. What is this NOPAT? NOPAT is PAT plus interest into 1 minus T. Is PAT plus interest into 1 minus T. So therefore, it is FCFF is equal to NOPAT, add depreciation and other non-cash items, less increase in working capital, or add or less changes in working capital, less CAPEX. Okay. Now we'll see FCFF can also be calculated from cash flow from operation. CFO is a GAAP number. You always see that in the cash flow statement given in the annual report, and we can derive FCFF from CFO. In the process, we also understand that CFO is not FCFF. So what is the difference? The difference is CFO less tax benefits of interest, less CAPEX is FCFF. So in order to understand this, let us see CFO. CFO is equal to PAT plus the non-operating item like interest, add depreciation and non-cash item, and the changes in working capital. So therefore, most of the adjustments required for the purpose of calculation of FCFF has already been done in CFO. The only thing which is not there is the CAPEX and the tax benefits of the interest. So FCFF can be calculated from PAT, can be calculated from EBIT, can be calculated from NOPAT, can be calculated from CFO. In the process, we also able to see that FCFF is adjusted PAT, adjusted EBIT, adjusted NOPAT, and adjusted CFO. Let us take an example of a company, Adani Green Energy Limited. It has been doing well on the basis of accounting reports. We can visit their annual report, and the annual report says that it's a company which is the world's largest solar power generation company and will be the largest renewable power company by the financial year 29-30. We are using the annual report for the year 2021. So let us see some financials of the company. Some of their achievements, operational achievement. They are having $3.93 billion, asset base, and they have $25 billion of fully built asset base, and they have 100% fixed PPA. PPA is a power purchase agreement for next 25 years, which will ensure their revenue. And they have lots of JVs, and they have been raising money in the market. Particularly, the debt has been increasing on their balance sheet. Let us see their financial performance. Financial performance of the company, if you see their accounting numbers, yes, the revenue has been increasing consistently for the last 4 years from 1,480 crores to 3,115 crores in 2021. EBITDA has gone up from 811 crore to 2,200 crore, and cash profit has also gone up. But remember, cash profit is not FCFF, okay? And other financial indicators, let us observe in their net profit was negative, and in the latest year, 2021, the net profit, they started showing the net profit, 183 crore. And what is important, maybe a matter of concern, that the company is highly leveraged and the debt amount has gone up from 8,000 crore to 15,000 crores over this period. But no information about the free cash flows. Okay, so they gave information of EBITDA, they gave information about net debt, they gave information about the net profit, but no information about the free cash flows. So therefore, a question that should come to mind is Adani Green Power or Green Energy generating profit, cash from operations or not. To do that, we will pick up their balance sheet and income statement. And this data, because I wanted to calculate the FCFF for a period of 5 to 6 years. So this data, the source is a screener, which provides the data available on the internet. So we use the screener database to calculate the FCFF. So they have a balance sheet. We can see that the reserves was negative -1 crore, has become positive 157 crore during this period, mostly because of the issue of shares. Their assets are the investments have been going up, and so we'll see the profit. The profits of the company, PAT, has been negative for quite some time and has become positive in the recent years. Now, with this information about the assets sources like equity and the liabilities, we can see that the liabilities have been rising significantly, quite a big jump in the liability. So what's happening to the free cash flows for the firm? Okay, so we will use these numbers to find free cash flows from PAT, from NOPAT, from CFO. Okay, so the PAT is equal to minus, we are calculating from March 17 to 21, okay, because we need change in the numbers. So therefore, we don't have March 15 data. So we'll calculate from 2017 to 2021. So we have seen here that from PAT, it is add interest, add depreciation, less changes in the working capital, and less the CAPEX. Okay, so PAT is equal to minus 49 crore in the year 79, in the year 2017, okay, and 423 in the year 2021. Okay, this is from their the screener's financial statements. Then add interest into 1 minus P. We have taken consistently 0.75, that is 0.25 as an interest. Okay, on so the interest is equal to 0.25. So I into 1 minus T. We can see the I into 1 minus T. I has gone up from 27 crore to 257 crore. So accordingly, I into 1 minus T also changed. Depreciation, we are adding interest because we want to find profit before it's the money available for all the investments. Then Okay, we'll call this as not balance sheet, but we'll call this FCFF. Okay, and the depreciation and amortization are the non-cash items from the income statement. We are adding it back because they have been deducted while computing the PAT, and depreciation is a non-cash item. Similarly, the changes in working capital, which is change in current assets and current liabilities other than cash. So we can see that the current assets have been rising. So increase in current assets is a non-cash item. So therefore, we are deducting it, and decrease in current liability is again an outflow cash. So therefore, we are changing the changes in a working capital is change in current assets and the current liability. You can straight find this working capital, okay? Or if you want to understand each component, it's not a bad idea to find the individual item of the current asset and current liability. But if you're projecting, if you want to find free cash flows for the future, so then maybe observe the working capital. Most of the finance books you see as the total working capital will be shown rather than showing individual current assets and current liabilities. CAPEX. CAPEX is a change in the change in the property, plant, and equipment. How much CAPEX or how much property, plant, and assets and other fixed assets have been acquired. PPE, property, plant, and equipment have been purchased during the year. So this we can derive by finding the change in the net assets, change in the net assets plus depreciation, change in the net assets. So CAPEX is equal to, I can write here. So CAPEX, because we're going to use CAPEX in all through this exercise, CAPEX is equal to the change in the PPE, okay, plus depreciation. Plus depreciation will give me whether you have purchased an asset during the period or you have changed the asset, you have sold the asset PPE during the period. So we have now done almost all the adjustments required for the purpose of the free cash flows for the firm. PAT, as we can see that, add interest into 1 minus T, add depreciation and amortization, less increase in working capital, and less CAPEX. And that's exactly what we did here. And it's important to observe this, that the FCFF of Adani Green is being negative. Only in 1 year, the FCFF is positive. Out of 5 years, 4 years, the company is not able to generate the free cash flows to make the money available for the investor, both debt holders and equity holders. So the company is having positive PAT of late, and has been revenues are rising, and they're claiming that they're creating wealth for the shareholders, but their company is not able to generate the free cash flow. Now let us do the same calculation, derive FCFF by using the NOPAT, by using net operating profit. What is net operating profit after tax and before interest? Is PAT plus interest into 1 minus T. That's what we saw here. NOPAT, we can calculate FCFF by making adjustment to the NOPAT. NOPAT plus depreciation and amortization, less change in the working capital, or plus minus change in the working capital, and less CAPEX. So in this case, because the working capital has increased, so in all the cases, we have written as less increase in working capital. So we can see that the NOPAT, adjusted NOPAT, is FCFF, and the result is same, right? So we can derive FCFF from PAT, or we can derive NOPAT from we can derive FCFF from the NOPAT What about CFO? We can derive FCFF from CFO too. Okay, let me hide this because we need space. Okay, so let us hide this, hide these columns, and see CFO. Let us first find CFO. What is CFO? CFO, as we mentioned here, CFO is equal to adjusted PAT. Adjusted for what? Adjusted for interest, adjusted for depreciation and amortization, and adjusted for changes in the operating working capital. So therefore, three of the important adjustments required for FCFF from the PAT has already been done in CFO. So therefore, what is not done is the CAPEX, adjustment for CAPEX and adjustment for tax benefits of interest. Here we add interest. We don't add interest into 1 minus T in CFO. So therefore, we have to make adjustment for the tax benefits of interest. So let us see that. So CFO is equal to negative. You can see except the year, the 21, 20, no, 19, in all the other years, CFO is also negative. Okay, so what is FCFF from CFO? Is CFO adjusted to the tax benefits of interest, and CAPEX will give us the free cash flows for the firm. We can see therefore that free cash flows for the firm can be derived from PAT, can be derived from NOPAT, can also be derived from the FC, from cash flow from operation. But in all the cases, whatever the approach you follow, we arrive at the same number, that is free cash flows for the firm. So what did we learn here? We wanted to understand that the company may be increasing its revenue, the company may be having profit on accounting, company may be having CFOs, but an important question that we need to ask is the company able to generate cash flows for beyond the CAPEX? So therefore, that is a surplus available to the debt holders and equity holders. And from the FCFF, if you make adjustment for interest and the change in the debt, you get free cash flows to equity. Now you may ask a question here, what is the need and purpose and use of calculating FCFF? FCFF is normally used to calculate the value of the firm. FCFF is normally used to calculate the value. FCFF is used to calculate the value of the firm. And FCFE is used to calculate the value of the equity. So FCFF discounted by using WACC will give me the value of the firm. And FCFE discounted by using cost of equity will give the value of equity. So FCFF, unlike the other indicators like EPS or PAT, because PAT and EPS are normally shown on the income statement and the balance sheet and the annual report, because they're statutory, they are required as per the relevant GAAP, generally accepted accounting principles. However, FCFF is not, but FCFF gives us an information about the cash generated by the company, and that too for the debt holders and equity holders. So to summarize, when you see a company, check whether the company is able to generate sales, that is the revenue. Whether the company is able to convert the revenue into profit, that is PAT. Whether the company is able to convert the PAT into CFO, cash from operation, that is CFO. And the most important, or after that, another important is whether the company's CFO is sufficient to meet the CAPEX. So therefore, is the company able to generate FCFF? So ask, check sales, check profit, check CFO, and check FCFF. in order to comment on the performance of the company. Thank you very much.